Good afternoon, ladies and gentlemen. Welcome to this Dhanteras and Diwali special panel on markets today. I am Shail Bhatnagar. With me is my colleague Sakshi, and we have a wonderful set of audience which is about to join us. Devina Mehra from First Global, Nilesh Shah from Envision Capital, and of course Mr. Sanghavi from ASK Raymond James are all with us to discuss the way forward. First to the lady. Good afternoon to you, Devina, and a very warm welcome. It seems that the worst is behind us as far as markets are concerned. At least a 9% correction on the Nifty, a very, very strong correction on many other indices. What have you been doing over the last 21 sessions? Have you bought something? And do you feel the worst is over?
Hi, Shell. Wish you a happy Diwali season, and same to everybody else on the panel and everyone else watching. As far as the correction is concerned, this was something that I'd been anticipating. We've spoken about it earlier in the year also, that sometime a correction would come. So that was on expected line. As you said, it hasn't even been a double-digit correction as far as the mainstream indices are concerned. However, there's a long list of stocks that has been circulating on social media which are down 30%, 40%, 50%, and even more. So again, this is something I've been anticipating, that there is froth in areas of the market in the micro cap, very small cap category, as well as in certain industry categories. So my stance has really remained unchanged, which is that I did not see a sustained crash in the large cap and the mainstream indices. However, I have been anticipating that there would be a lot of grief in a lot of areas which have been, you can say popular. So that's pretty much how it has played out. Is it made a bottom? Will it not go any further down? That you can't say for sure. I mean, maybe it will go down a bit more also. But I do not see a sustained crash simply because we are not above the trend line on the mainstream indices. The sustained crash comes when you're way above the trend line. Like the 2008 crash was after the market had gone up 6 times in less than 5 years. So, that's what causes those kind of crashes.
True. Very good afternoon to everyone. Let me welcome Mr. Shah also on the panel. And straight up, I want to understand from you, although the last few days, 1 month, so to speak, has been tepid, corrective phase in the markets. But this Samvat so far has actually been pretty good when we talk about equities, gold, real estate. It's all been very well for all the asset classes. What is the outlook that you would have for equities and also gold, if you could share for the next Samvat now?
Happy Dhanteras, happy Diwali to you and all the viewers and all your families as well.
Thank you.
Pleasure to be on this very special show on a very special occasion. Yes, it's been a great last 12 months, though of course maybe the last few days or maybe the last couple of weeks probably have been a little tepid and have led to some kind of correction. But I still believe that the best is yet to come. I remember same time last year as well, there were continuing to be concerns about the market outlook and the outlook for various asset classes. And look, I mean, it's ended up being a great year. I think in the last 1 year, we've continued to see the economy grow, earnings grow. We've had now a stable government for the next 5 years. Those concerns have also been put to rest. There have been geopolitical tensions, which essentially was expected to kind of lead to a spike in crude oil prices, but that's also not happened. So I clearly think overall a lot has gone in favor of India and a lot has gone in favor of markets in general. Going forward also, we may have probably a bit of a J curve where in the very short term we could continue to see some kind of a dip or a correction. But I think post that, clearly given that we've had a good monsoon, rural economies on the cusp of a pickup, interest rates seem to be heading lower. I think on the back of all of that, I would not be surprised if we have one more good year. It's always very subjective in terms of what is a good year. But I think as long as markets deliver even low teens kind of returns, early double-digit returns, I think that would essentially be a good place to be in. So I think I continue to be very positive, continue to be very sanguine in terms of the outlook, not barring some kind of corrections that can happen in the very short term.
Okay. Ladies and gentlemen, all three guests manage public money. Nilesh ji and Devina ji run a very well-known PMS scheme. One is Envision, the other is First Global. And Vaibhav ji is a uniquely placed individual here. He runs a long short fund. And that brings us to a wonderful question, Sangvi Saab. In this day and age where you've seen a very, very sharp fall in markets over the last 21, 22 trading sessions on the main indices, but over the last 3 months on many, many other indices and stocks. What is your long short ratio at the moment within the fund? And is it turning more towards short now, or do you feel that enough is enough and now it's time to book the shorts?
No, I think, again, a good question. But before that, I'll just wish you all a very, very happy Diwali and a Dhanteras. All the investors, all the viewers and the team out there, along with my co-panelists. Now, when we look at, when we are entering this month, at the start of the October, what we did see is basically we are entering into an earnings season, which is likely to be weak. At the same time, what we had also seen is basically valuations. I mean, there is no debate about it that it were trading a little, kind of expensive. And lastly, from a catalyst perspective, what happened in China in terms of the stimulus, and subsequent to that, what we saw is basically a huge amount of money actually flowing into China from all other emerging markets. What kind of happened is basically proved as a catalyst in the domestic markets to take the market on a correction spree. While the headline number is what you probably see, but the breadth of the market has been even worse actually. So wherever we have seen deterioration in terms of the share prices, I think it is also kind of a reality check in terms of our expectations from equities as an asset class. So our view is that yes, I mean, we came into the month highly hedged. We continue with our hedges, but at this point in time, after this correction, we are turning a little bit constructive. I'm not seeing that we are going all out in terms of our bullish stance, but probably the kind of view which we had starting of the month, I think we are a little better than that.
Devina ma'am, let me come to you. I want to understand from you, from here until the next Samvat, where do you see outperformance to come in? For someone starting absolutely afresh now, looking at this correction, wanting to start a fresh portfolio, what are the pockets that one should look at?
Actually, I mean, Sakshi, the thing is that the way we manage our PMS, it doesn't matter whether you entered today or you had entered 3 years ago. Everybody has exactly the same portfolio because what we do every quarter in particular is a zero-based rebalance. That today, if we had cash, where should we be? Which are the best places to be in today? Without looking at what we already hold, because otherwise it is something called an endowment bias where you value something more highly simply because you hold it. I
Correct.
always say the hold rating itself exists because of endowment bias, because otherwise rationally anything you should not you should not buy today, you should not hold either. So in that context, I'll tell you, because we are just about finishing our latest rebalance, because this is the first month of the quarter, and I'll tell you what the changes have been. One big change, the industrial machinery and capital goods, that sector, we had been overweight for 3 years now, since October 21. Most fund managers kind of discovered industrials in 2023 when most of the story was actually already over. Stocks had already doubled and tripled. So after 3 years, first time we are underweight in that sector. So that's been one change. Sectors which we have been overweight on for about let's say from beginning of 2023 and where we are still significantly overweight are pharma, healthcare, auto components, not as long as that, but IT services also now we are overweight. In the last July rebalance, in this rebalance, sectors we have added on have been some FMCG and chemicals. So chemicals was a sector that made a lot of money for us in 20 to 2022. But then once our system stopped liking it, we got out of it. So after 2 years, Now, chemical stocks have been making a comeback. They have been now ranking higher in our systems, and we've been buying a little more of that. So that would be the broad pattern as to where we are.
Okay. Let's get Nilesh Bhai into the conversation. It's been a fairly painful 21-22 sessions, Nilesh ji, the most recent ones that we've suffered in terms of the cut in indices and stock prices. What is the level of cash at Envision across portfolios? And how will you be deploying this cash in the coming quarters, given the backdrop of second quarter earnings, which have been terrible?
So we broadly have about maybe around 5% cash levels, maybe in the portfolios which we would have probably subscriptions that we would have got probably in the last 1 week or 1 month. Maybe the cash levels then will be higher because we normally take a few days or few weeks to put that money to work. We don't necessarily get 95 or 100% invested on day zero, day one. So yeah, I mean that's it. We don't take any active cash calls. Basically, we believe our mandate is to keep identifying value. We are investors with a long-term horizon. A 3 to 5 year horizon is something that we look out for that works best for us, and we continuously try and identify businesses which we think will do well over a 3 to 5 year horizon, and that's where we kind of keep deploying our capital.
Okay. Mr. Sanghavi, let me get you into the conversation as well. You know, the one point that Shell made on the earnings especially, that's something that I wanted to understand from you. We're getting more downgrades, hardly any upgrades. While the economy is growing, we're not seeing the earnings as much. Why is there this disconnect, so to speak? And because of this, how long do you think the indices will continue to dampen the investors' sentiments?
Yeah, I think just kind of a preset here is basically in the last couple of years, the earnings have been, pretty good. I think we've seen consistent upgrades. And what we've seen from a consistent upgrade perspective as well, when you just go a little bit below, is it has been because of a much better margin profile. Now, going forward, what we do think is basically when there is an overall pressure in terms of the growth, both globally and locally, our sense is basically that companies would kind of try and sacrifice some amount of margins in the possibility of kind of grabbing more market share or maintaining your market share. So we have seen some amount of that kind of pressure coming about in this quarter, and especially we've seen something in the whole consumption basket as well. So while consumption basket is actually mired with both the top line and the margin problems, but my sense is basically that going forward on an over broad-based perspective, we have to probably downgrade our forecast in terms of the earnings growth, at least for the next 2 years, which is in my FY 25-26. While the consensus is close to about say 10-11% and 14-15% for FY 26, then my sense is we will see some amount of down. Lastly, I think what we also need to see is that in this kind of downgrade, we need to also marry that with the current valuations as well. So it's difficult to retain higher valuations when you are in a situation when the earnings are getting downgraded. So all in all, our thesis is that the expected rate of return on equities as an asset class might see some amount of moderation as compared to what we've seen in the last 3 years.
This is an issue that we've been grappling for a long time. From the low of COVID, the index itself has tripled. What talk about individual stocks? What talk about broader indices like the NSE 100 and 200? We've made lots and lots of money. And as one of our common friends was telling me the other day, that we borrowed this return from the future. तो उसको वापस करना पड़ेगा, आप चाहे देर में करें या लगातार करें, वो देखी जाएगी. But Devina and Nilesh, this is a question both to you. Are we now in a value buying kind of a market, or are we chasing growth? Devina, to you first.
You asked me or you asked Nilesh?
Yes. Now, both of you, you go first.
So I am always, whenever people ask me that are you a value investor or a growth investor, I say no theme lasts forever. So no sectoral theme, no market cap theme, no investment strategies theme. So we don't really try to put things in silos. So we essentially look at a range of financial ratios, which I mean, we don't do physically ourselves. It is kind of encoding our expertise into an artificial intelligence machine learning system so that the entire universe of stocks can be mapped out without bias and without any random noise coming in. So we look at stocks over 1,000 crore market cap. So roughly 750, 800 stocks are there. So all of them are ranked on exactly the same basis. And we might pick out, let's say, the top 55 out of the top 75 with a few others coming through some of our other systems. So and I told you that which are the sectors where we see that which could give better returns where we are overweight, that I've already spoken about. One, and we always manage for risk first, because as I often repeat, you win only if you don't lose. Investing is a loser's game. So your first aim has to be that you don't lose big money. So, for example, we don't look at stocks below 1,000 crore market cap. Between 1,000 to 5,000 crore market cap, we normally have maybe about 14-15% of our portfolio. For the last few quarters, we have been at 5% of our portfolio. We knew this would hurt performance in the short term because you could see the momentum in small caps, but that was not a risk that we were willing to take. So that's a decision made. So I mean, that because you cannot manage risk for those kind of stocks, as I've repeated again often enough, many of them, when the small cap universe falls, many of those stocks just disappear into the blue yonder. They never come back. And often it like the fall is so steep that you can't get out, and so you can't have stop losses in small caps. In large caps, stop losses work, but not in small caps. You cannot hedge small caps because the only hedge available is a Nifty put, which doesn't move along with small caps. So that was one area. There have been many other areas in the last few quarters where there's been frauds, that was PSU or defense or so-called industrials, manufacturing. So always, as I always, it's only a little flippant that the rule of thumb to identify where there is froth are areas where the most new fund offerings, the new mutual fund and PMS schemes are coming. Those are the things where the themes are probably topping out. So those are the frameworks we use. So as I said, I've already mentioned the sectors which we like currently.
Nilesh bhai, would you like to take a shot? Where would future capital be deployed? Does value make sense now, or you've always been a growth guy?
Yep, so Shell, there are still plenty of opportunities. We clearly believe that there are several structural growth opportunities from an India standpoint. Clearly believe that digitization is the biggest phenomena that's basically shaping and reshaping how we live, how we work, how we consume, how we save, how we invest. So clearly, I think digitization is a very, very powerful and a profound kind of structural opportunity which is emerging. The second is around urbanization. The fact is India is getting more and more aspirational as incomes rise. So do our aspirations, and as aspirations rise, so do our consumption patterns, and therefore there are new categories which are emerging, which essentially are going to grow in a significantly higher manner. Third is financialization. I clearly believe that India is going to essentially witness a much higher level of financialization, which is across credit, savings, investments, insurance, protection. These are the kind of sub-segments or categories which again are going to witness some really steady to strong growth. And the fourth is, very different from conventional IT services, but there are going to be a whole bunch of specialized IT services companies which are going to be focused on providing artificial intelligence, data analytics, related services to a very large segment of global companies. So I clearly believe that there are these kind of opportunities, and I think our endeavor is to identify category defining companies which essentially are wanting to grow, but at the same time are very cognizant about capital efficiency and the capital allocation. So that's essentially what we are trying to be focused on. And I think our job is to kind of keep figuring out a bunch of 20, 30, 40 companies at any point of time in a universe of 2 to 3,000 companies who essentially fit the bill. So that's essentially what our philosophy and what our endeavor is.
Okay, Mr. Sanghavi, let me get you in here. Which are the pockets that you believe that continue to draw investors' attention after the recent correction that we have seen, and where do you still feel is a no-go area despite the correction that we have seen thus far?
I think let me take the second part of the question first, and where do we think currently is from a weakness perspective is we still believe that overall domestic versus global is a theme to be continued to play with, wherein what we are saying is basically that I think global economies are under far more pressure than what we would be going through, and within that I think any companies which are facing towards higher revenue from the global standpoint are something which would likely to be weak going forward. Now, this is not saying that I am not, those are not the quality companies or probably will not do well in the 3 to 5 year perspective, but it is just from 6 to 12 months perspective. These are the companies which will continue to be under pressure. With respect to the opportunities, I think we are strong believers of a multi-decade opportunity in terms of the renewables. And when we talk about renewables, I mean the net zero kind of commitments across the globe is going to drive all the ancillary sectors which are catering to that big opportunity. So that is something which we are keen with. Second is basically the overall CDMO opportunity because of the Biosecure Act. I think this is a space probably to look forward to at least for the next 2 to 3 years. We will see good amount of traction within them. And lastly, in terms of financial services is something which we continue to like as well. So those are the pockets we think there are good amount of opportunities.
Okay. Vaibhavji, my question to you is that at this point of time, if you could, if it's possible for you regulatorily to share with us the number of stocks where you are short and the number of stocks that you are long on, and if you could just give us a feel how many of them are in any kind of a silo, whether you want to break them up into large caps or small caps, or if you want to break them sectorally. I just want to understand what is the map in your mind when you go long and short.
See, when we are talking about a long short fund, I think the larger universe of a long short fund is to large cap and large mid caps. So it has to be into derivative universe largely. Secondly, in terms of the number of stocks, it will be very misguiding in terms of, because what generally happens is that when you are operating a long short portfolio, the number of stocks in total would be far in excess of 60, 70 names on an overall basis. It is an extremely well diversified portfolio, both on the long side and the short side, so that you're not exposed to any kind of one stock particular risk as well. So diversification being the key, the combined portfolio will be across 70, 80 names, which may be there into the portfolios.
Devina, let me come to you. I wanted to bring in the FII question now. Of course, that has been the moot point of this pressure that we have seen over the last 1 month, although DIIs have stepped up at every way, every day, and bought equal, if not more. 1 lakh crore gone in a matter of just 1 month, and the markets have been digesting it with the support coming in by way of SIPs, mutual fund flows, domestic institutional investors, retail investors at large. What will be the trigger point for FIIs to return to Indian markets, or are we not worried if they continue to sell in the Indian markets at the same pace?
Actually, I have been getting this question forever as to where do you see the FII flows, and underlying theme for that always is that you think that when FIIs bring in money, the market goes up, and when FIIs take out money, the market goes down. Of course, it has happened this month, but if you look at overall, there is actually no correlation between FIIs net inflows and outflows and the market direction. And this was so, I mean, now of course the retail money is large, mutual funds are large, but this was so, even when the mutual fund industry practically did not exist, retail participation was far lower. And the biggest example of that is that the FII started investing in India around 1994. And I know because, the budget provision by Dr. Manmohan Singh to bring in foreign institutional investors was the trigger for me to start First Global 31 years ago. But the point is, this was a fresh new slew of money because earlier the foreigners could not invest in India, and then they started investing around 1994. But 94 to 2003 is the only 9-year period in the Sensex history where the net return was zero. So it is as disconnected as that. So let alone cause the market movement, there is no correlation with the market movement. I do not even track FII flows from market movement perspective for years now. I mean, balance of payment is another matter. So I don't think there's any point, trying to speculate what will FIIs do. And again, you can, make the argument either way that money will go from India to China or is going from India to China. But on the other hand, China is the biggest component of the emerging market index. So you could just as well say that China does well, emerging markets will start to look more attractive and more money will go into the emerging market pool, and therefore some will come to India also. That's like a fool's errand to my mind to try and speculate on what will happen to FII flows, thinking that is what will determine market direction.
It's always better to have larger problems in life rather than worry about what FIs will do tomorrow. It's always good to look at where the next pot of gold is, and that is what Nilesh Bhai will tell us. Nilesh Bhai, we've seen this two developments happening. One, the disengagement with China on the border, and perhaps we will also see visas being eased out for Indian companies who are looking for Chinese nationals to set up factories, as also to improve, to get in more equipment. Is there a sector where you feel the biggest benefit of this disengagement will happen within the listed universe?
So I think the biggest thing to learn from probably from China is basically the manufacturing kind of space. That's really where China has more than proved its mettle. It essentially continues to dominate that space. And it's something which India needs to look up to, because ultimately we want that shift from farms to factories. It essentially has to be a very turbocharged manufacturing kind of space. So clearly believe that's one big area that essentially which will benefit, because as the relations between India and China improve, and as both the administrations try to basically promote business associations, I clearly believe manufacturing is that space where will be a direct beneficiary of that. China has in manufacturing, of course, created basically, I would say, planet scale capacity in different sectors. Clearly, I think from an India standpoint, we've started on the electronics journey in terms of trying to be ourselves being more self-sufficient. But clearly that ecosystem needs to essentially be even more complete. The whole focus on semiconductors and chips will play a very, very kind of big role. So while we may want to talk about China plus as the opportunity for India manufacturing, I actually think it's going to be the India plus opportunity, which is where we kind of up the game on manufacturing side, cater to our domestic demand, and then also essentially become globally competitive, be part of the global supply chain, and start selling to the rest of the world and become net exporters. So I think that's a huge lesson which obviously we need to essentially inculcate, and clearly normalization or better ties between India and China will play a very pivotal and a cardinal role in upping our game in the manufacturing space.
Okay. Let me bring you in, Mr. Sanghavi, right there to understand from you what is are most of the risks already priced into the markets right now, or is there any other risk which could be still seen as an overhang? What is it that you're looking at most closely in the market right now?
Yeah, I think a good amount of them have, kind of played out in some sense. But my view is that from a longer term perspective, market generally follows the amount of earnings which kind of come onto the table. Now, in between, you will see some amount of euphoria or probably some amount of, below the average kind of multiples as well. But largely, you will generally follow how much the earnings grow, and you will keep on gaining as an asset class. Now, if the earnings, and that is one risk which we do see, is that from a global perspective, which things starts getting weakened and local kind of economic kind of slowing, which to some extent we are currently witnessing. There can be some amount of pressure, in terms of the earnings and subsequent, movement in terms of the overall benchmark index. So that is something to kind of watch out. And with a situation where your market cap to GDP close to 140, 145%, and your P valuations kind of standard deviation +1, +2 kind of trading across the companies is where my only risk factor is there. I'm not saying that equities as an asset class will not do good. From a 3 to 5 year perspective, still it will continue to deliver, but it may not be a linear journey. You may see some volatility, turbulence in the initial probably part, and then probably catch up in terms of our earnings as well. So that patience, in my view, is a time, the time has come probably that the patience may be tested at least for some time.
Vaibhavji, the one quote that I always remember as far as markets are concerned is, here is an investor asking God for patience but asking it very quickly. So this is how life is. And till about 2020 of April, all of us on this panel were very sure that returns in equities come in batches and in small percentages, but the entire history and landscape has changed post COVID. Everybody is used to a 1.5% uptick on the Nifty each month. What talk of small cap and mid cap indices? 2% chahiye. But such is life. Devina, this comes to you and then to Nilesh bhai. What are the two risk factors do you think that might derail this lovely momentum that we still have on Indian markets?
The Morgan Housel says that risk is what you do not anticipate. So always remember that risk is never easy to anticipate. The beginning of you were talking about 2020, beginning of 2020, obviously nobody foresaw the pandemic. But if I had told you at beginning of 2020 that there will be something which will be so disruptive that hotel business, travel business, retail business, everything will go to zero in large parts of the world, would you have ever predicted a bull run? So in hindsight, we always find stories to justify what has happened, but very hard to anticipate. If you look at 2022, for example, you look at the January issue of The Economist, they talk about geopolitical risk and 10 hotspots around the world where there was geopolitical risk, and they do not mention Russia, Ukraine, where there was a war the very next month. So that's how difficult it is to anticipate. In terms of the economy, I have never been, people, after the market has come down, a lot of people have suddenly discovered that there are risks in the economy or the economy was not uniformly doing well. But those were things which I have pointed out for a long time, because the economy and the market are two different things. On the economy front, we know unemployment has been high. And while the headline GDP number has been good, the private consumption number in GDP has been, even as of last year, was at a 21-year low. So, I mean, it was, the writing was very clearly on the wall. So it's only, and it's not as if that this quarter HUL and Nestle have started saying things. I had even tweeted from this book called The Lilliput Land, which shows that from 2016 onwards, for the bottom 60% of India's population, income has been declining. It is not just that inequality has been increasing. The actual income has been declining. Bottom 60% of the people, even without accounting for one-time expenditure like marriages or medical or whatever, have a negative income minus expense number. There is, negative savings. So those issues have been there. And which is why every budget, my wish list from the government has always been now for the last several years that health, education and employment. It has never been market related ask, because unless you solve those things, your long-term growth cannot be sustained or guaranteed. If you look at manufacturing alone, we've made a lot of noise about manufacturing, but you look at manufacturing as a percentage of GDP, it is the lowest it has been since 1969. So we went from 17.5% of GDP in manufacturing down to 13.5. So because I'm a data person, I look at data. So it's not as if I look at data only once the market goes down. But of course, the listed universe is slightly different from the economy as a whole, which is why, because many of those companies actually gained because post demonetization and GST, a lot of SMEs went out of business. The business became more organized. Also, in many industries, the listed companies deal with the more affluent segment. For example, if you look at real estate, the listed real estate companies deal with the affluent consumer, not with the residents of India as a whole. So, those nuances you have to build in, and the disconnect can go either way. For China, the China market made a high in 2007. The economy went up 7 times. The market did not take out its high. So, the disconnect can happen either way. So you have to look at the market slightly differently.
Yes, and that's the reason why we have all such intelligent people on the panel fairly regularly on the show to guide us where to put in money, where to take it out. Nilesh bhai, according to you, 2 risks that the market still faces.
I think, Shell, we are essentially a growth market. I mean, whether we like it or not, people like to come to India or we invest in equities purely because of growth. I think any risk to growth itself. I mean, today we may want to say that our markets are down because FIs are selling, and FIs are selling because they think China is more attractive. I'm not too sure entirely whether that's the reason. I clearly believe it's basically the expectations around growth, or maybe a bit of moderation of growth is basically not. Is giving a bit of the jitters to the market. So to me, the biggest risk is growth. I mean, apart from that, at a company level, it's always about capital efficiency and capital allocation. I mean, when businesses turn capital inefficient, or when there's missed capital allocation, that essentially creates the landmine for investors. So I broadly think it's always around growth, capital efficiency, and capital allocation, which presents both the opportunities and the risks. So those are the 3 variables which create the opportunity. But at the same time, those are essentially the 3 biggest moving parts because of which challenges get created or risks come to the fore.
Okay, well, we are going to be coming to a fag end of our discussion, this wonderful panel. But I want to ask all 3 of you all, what is the kind of expectation that we can have for the Nifty over the next Samvat? So I'll start off with Vaibhav, you first. 2 great years is what we've already seen, above average 19-20%. Is the 3rd year going to be as lucky?
So I think going forward, I think low double-digit returns probably something you would probably want to think about. Lastly, one more aspect in terms of your net returns in your hands, you also have to factor into the marginal higher rate of taxation as well. So post-tax return in your hand is something which will be moderated as compared to the last 2 to 3 years.
Moderate expectations. Okay, Devina ma'am, I know that you do not give targets, but how moderate should our expectations be for over the next one Samvat?
Yeah, I mean, I don't give targets. For 30 years, I've never given targets. And I got the word for it, the phrase for it, only a year and a half ago when I read Daniel Kahneman's Noise, and he calls it objective ignorance, something that you not just don't know, but you cannot know. And to speak about something you cannot know with confidence is a sign of idiocy. So that's what he talks about. Yeah, I mean, see, that's the whole point. As I said, if you step back, there was a whole decade, 2010 to 20, when you didn't even get 9% compounded. Over 40, 45 years, you got whatever, somewhere around 15% compounded. So that one decade of below normal returns is what gave you these above normal returns. So you can't say on a year's basis, but as I said, I'm not really negative on the large cap and mainstream indices. But areas where there's been a lot of frauds, whether it is sectors, whether it is the IPO whole, we didn't get a chance to speak about this whole IPO fraud. So those are the areas where you don't know what will happen, because equity market returns are A, lumpy, and B, a lot of bull market stocks never make a comeback. So while market as a whole, there is some predictability, but the stocks can go down to zero, and more than half the stocks ever listed on the markets have gone to zero.
Okay. Nilesh, at least we will see 28,000 on the Nifty or even lower.
28,000, which on a base of 24,500, 2,800 is like about 12, 13%, or maybe 14, 15%. Yeah, I probably think so. I mean, that range of 10 to 15% should be quite possible. I mean, this is more contingent upon, the earnings growth being there. Like, I mean, the Nifty per se, essentially, in terms of P multiples, there is no froth. We probably might be trading at a marginal premium to long-term averages, but that's fine as long as we end up delivering even low double-digit kind of growth rates, and that's what I think corporate India will deliver. So yeah, I mean, I'm not so circumspect. I think we should have a relatively fine year.
Wonderful. With those fabulous hopes, ladies and gentlemen, let's call it a day for the panel. Thank you so much for all this wonderful discussion. And I must admit publicly that the chart at Lucknow is better than the chart in Delhi. This is a common joke between Sakshi, Devina, and me. We once held a show where we went out for chart in Delhi, and the first comment Devina made was
Yeah.
भाई ये सब ठीक है लेकिन लखनऊ की चाट लखनऊ की चाट. So we agree, and the next round of that show will be in Lucknow with Vaibhav and Nilesh also invited.
Looking forward to
Inshallah.
that.
Would love to.
Wonderful to have you all. I wish you all have a great Diwali ahead. Thank you so much for being with us. And with that, we wrap up this very special edition. I hope all our investors have and viewers have taken all those notes coming in as masterclass on this special edition. But don't go anywhere. There's a lot more to take in. We have to come back for the closing edition, and we'll be back very soon.
And joining us now is Mr. Atul Kumar Goyal, the MD and Chief Executive Officer at Punjab National Bank. Namaste, Mr. Goyal. A very warm welcome to you, sir. And just let me brief our viewers with the numbers that have come in from PNB. They are fantastic, both on the bottom line and the top line. Net profit for the second quarter is up a whopping 145% to 4,000.